Hi, Colleen O'Connell-Campbell here, wealth advisor at RBC Dominion Securities and host of the Cash Rich Exit podcast. I'm joined today by Tania Guido, an estate planning specialist with RBC Wealth Management Financial Services. It's always a mouthful. Tania has over 30 years of financial service experience and is known for being a thoughtful, transparent advisor, taking that type of approach to insurance planning, helping clients and their advisors like me make confident decisions around personal and corporate strategies. So, you may have heard somebody say corporate insurance can act like a corporate TFSA. Maybe, maybe not, but this is a phrase that we use. And today we'll separate the hype from the fit because the right tool in the wrong situation is still a wrong answer. But the right tool in the right situation can be just the right answer. Now, before we jump in, a quick compliance note. This video is for general information and education only. It is not legal, accounting, estate planning, tax, or insurance advice. Please review the full disclaimer that will come on later in the episode here on the screen and in the description, and speak with your professional advisors about your specific situation. All right, with all that aside, hi, Tania.
Hi, Colleen. Thanks for having me.
Well, I'm grateful for you to be here, and this is a video in a series of videos that we are putting together to chat about insurance as a tool. And this is one of the more, I guess, fun and exciting ones, but also, as I mentioned, there's a lot of hype around using corporate insurance. So let's talk about um, first and foremost, like, what is this concept that I've brought to the table, corporate TFSA? What do we mean by that?
So very simplistically, obviously it's a catchy phrase, right?
Hmm.
But ultimately, the purpose why it sort of goes towards the tax-free savings account, or that analogy is because when you think about insurance and you think about whether it's corporate or in the personal setting, permanent insurance in particular allows for all the growth, all the values that grow inside of the policy to stay tax sheltered as long as it stays within the insurance policy. And then upon passing, that that growth, the value that it's grown to, then pays out as a tax-free benefit. So it's not a TFSA, and I want to make sure that everybody understands that, but it's coined to be similar to a tax-free savings account because as long as everything stays within the insurance policy and pays out as a death benefit, it all pays out tax-free.
And it's just a nice way to describe the difference between insurance from the perspective of what we talked about in a previous video around risk management. Like what the original
Mhm.
purpose of insurance was to fill a gap in the event of something precarious happening in your life. You are, the lead of the business, the lead of the of bringing in the revenue and income into your family. If you're not there to do those things, then what is the financial impact and can that be replaced with some level of insurance, right? But now we're
Correct.
talking about using insurance more from an investment perspective and what are the interesting features that are available that can create this sort of additional tax shelter. And it's nice to have terms that sort of help to make sense of what may seem complicated. So we coined it the corporate
Hmm.
TFSA, right?
Exactly. Exactly.
Um, okay, so what would be the next best thing to look at? Like who is it best for?
Yeah.
Who should consider looking at a corporate TFSA? For obviously we are talking about from the business perspective. What type of business and business owners should look at this?
Yeah, so that's a great question. I mean, I think that the important part of that is, when you're being spoken to, so, if I'm a business owner and I am sort of sitting with an advisor, I want to make sure that one, I have stable and predictable cash flow to fund this long-term strategy tool that I'm going to incorporate in my plan. Okay. So certainly somebody that, can put aside X amount of dollars every year for a period of time, 10, 15, 20 years, for example, that's not going to impact, their regular businesses, if you will. Okay. There has to be, I think, a clear purpose and plan, right? I sometimes say this is your never money. This
Hmm.
is money that you do not need during your lifetime, and it's really set aside to help that estate plan upon your passing, whatever taxes, everything that we can flow, to your estate, to your beneficiaries tax efficiently. So I think those are probably the two main things I would look at is one, you've got that steady cash flow and you've got a clear purpose of this money because I would hate for somebody to set this up and then all of a sudden, 7 years down the road or 5 years down the road, they're like, oh, this isn't a good idea because I really need this money for my business or for other
Hmm.
purposes. So I think that's going to be really, important to look at when you are considering this type of solution.
So you mentioned stable cash flow. It's, I when I'm looking at this situation and where I bring you in to talk to a client, it's typically when they have, and I'm not going to put a specific dollar amount on, but they have like a holding company with passive investments. And those passive investments are, they're earning dividends, interest. You can argue, there are better, certain better ways of investing, but we have to also look at the risk tolerance of the individual. So especially in cases where there's, to your point, money that's probably not going to be used during that business owner's lifetime, and possibly really bond-like, GIC-like investments where they really don't want to take on a whole lot of market volatility risk. And we know that interest income in a corporation is really not taxed at favorable rates.
No.
And so that's a time when I would look to you to come and talk to my client, my prospective client, about how this corporate TFSA might fit um, into their strategy. So maybe we could take it down another pathway there and just talk about what it is about the features of whether it's, and we don't even have to get into the whether it's a universal life or a whole life, because that gets into another level, which maybe we can have another conversation about and actually show some numbers. But high level, why is it that, how is it that this tax shelter-ish kind of feature is there?
Yeah. So before I get into that, I just want to jump on one thing that you mentioned just a
Okay.
second ago. And I think that's really important about, and again, I don't want to say that this is always the case, but holding company. Why would we consider this in your holding company versus your operating company? Well,
Good point.
chances are, depending on what kind of business you have, could that operating company be sold? Could that operating company, be dismantled at any point in time? And so the question you have to ask yourself is if that is going to happen and we have insurance under that corporation, well, now we've got to figure out what are we going to do with that insurance and transferring it from, one corporation over to yourself individually or to another. And again, I put an asterisk here, could trigger some taxation. So during the conversations that I have with clients, I really try to go down that path of making sure we're setting it up properly
Hmm.
within the right company so that we can avoid as much risk. Sometimes things are unavoidable, but we really try to set it up so that we know the future path of that business or businesses.
Right.
Okay. I just wanted to
No,
jump on
that's a
that.
good, yeah, that's a good point.
Yeah.
I layered in some questions there, but let's go back to the features
Yes.
of permanent insurance and
Mhm.
why it works
For sure.
for long-term money that doesn't have a job description in the lifetime, we'll say, of the current owner.
Right, right. Okay, so again, not going down the path of really diving deep into the different types of permanent insurance, but if we just think of permanent insurance in general with the space that we're talking about. So first and foremost, for $1 that you're putting into insurance, you immediately get an estate benefit. Okay. So
Hmm.
you've got that insurance benefit that's tax-free payable to the corporation. Okay, number one. Number two, no matter which, again, solution you're choosing, participating whole life or universal life insurance, there is a component that there is going to be growth that's going to take place
Hmm.
within that policy on the insurance benefit. And then there's a pocket of cash value. So again, different maybe topic we'll talk about, but
Hmm.
cash value. The growth that takes place within those two plans, okay, and how it grows stays tax sheltered. So all that growth, if you think of it inside of your holding company and if you're just investing it, like you mentioned, Colleen, you're losing 50% of that growth to taxes. But here, all of that growth stays tax sheltered, once again, as long as it stays inside of the policy.
Hmm.
And so then when we think about again, the estate benefit side of it, right? And I think that's going to be another piece that we'll talk about at another series is going to be how do we get it out of the corporation? So the insurance benefits gone into the corporation tax free. And then how do we get it out of the corporation on a tax efficient basis? Which I'm not going to go there right at this moment.
Yeah.
But what I think I want to say to end sort of or full circle this is that if you looked at the same insurance or the same deposit that you're putting into an insurance policy versus maybe thinking about it as an investment inside of your corporation, okay, you are well ahead of your, plan if you considered insurance for the reasons that I mentioned. Again, tax-free estate benefit, tax sheltered growth, right? There's that protection there
Hmm.
for monies being there today and into the future versus having it inside of your hold co. If you're not needing this money,
Hmm.
think about utilizing this for another place to park
Yeah.
some of that taxable money.
And I would say that this conversation shouldn't be done in a silo. It should be done. It shouldn't be done in a silo. It shouldn't be done with just an insurance advisor, just a financial planner. It really needs to be looked at in collaboration and in coordination with your entire plan, accountant, corporate structure, insurance professional, financial planner. And that being said, before we wrap up this conversation, um, where have you seen this go wrong? Implemented
Yeah.
and gone wrong.
Yeah, and I think, again, I think that sometimes we look at something and it looks great, and it's like we want to act on it really fast. And I think that, you know, we have to take a step back and we have to really make sure that this is the right purpose for our future as a business, as a corporation, and make sure that you've got a clear intent of again, this policy being there. It's considered, untouchable with a few asterisks beside it, and we can get
Hmm.
into that another time. But realistically, it's there for your future and your estate, your legacy, right? So, and making sure that your cash flow matches that. So, once again, making sure you're compromising with how much we're going to put towards this and how much do I keep into my corp because I need it for other reasons for retirement and so on. the time horizon again is that this is long term. This isn't something that you're going to, of course, you know, decide to cancel or decide things happen and that might end up happening, but that's not shouldn't be the intent of it. It really, again, should be there for your lifetime. And so again, and the last thing I think, you touched on it, it's just the coordination of your entire team. Yourself, Colleen, myself as an insurance planner, your accountant, your lawyer, depending on the size and the complexity of your business, you really want to make sure that all of your team members are in place, advising you correctly, and it's not siloed or mismatched.
That's perfect. And as you said, we didn't get into how the money is flowed out. That's coming up in a next video where we're going to touch on something called the CDA or capital dividend account and preface that we're not accountants, but it is something that is important to have overview understanding of. Those of us in the field who work in coordination with accountants, and also as a business owner, if you not fully understood these concepts, this is a good opportunity for a layperson to layperson to have a conversation. So that's coming up in a little bit. I hope that you garnered some insight into this topic of corporate tax-free savings accounts, or at least that's what we like to call them, and how they might fit for you. Invite you to have a conversation and determine, whether or not it would be worth the due diligence of bringing your team together and having an illustration put together, looking at how that might fill some of the things that are important to you. Your exit, it might be interesting for purifying some of the assets in your corporation. Who knows? But it always starts with a conversation and an exploration. So feel free to reach out when you have the opportunity. I can be found through email, colleen.campbell@rbc.com, and you can also find me on LinkedIn under my full name, Colleen O'Connell-Campbell. And before I let you go, today we want to let you know that all opinions expressed by me and any guests here on the YouTube channel are solely their own and do not reflect the opinion of RBC Dominion Securities. This video is for information purposes only. Before acting on anything you hear or see, consult a qualified professional. Insurance products are offered through RBC Wealth Management Financial Services, Inc., a subsidiary of RBC Dominion Securities, Inc., and this content is produced with Canadian residents of the province of Ontario in mind. I'm a wealth advisor with RBC Dominion Securities, a member of the Canadian Investor Protection Fund.